Welcome to today's Explainer. We've got a massive financial mystery to unpack right off the bat. Right now, the broader stock market is flirting with all-time highs. Everyone around you seems to be making money hand over fist. But Berkshire Hathaway, the most disciplined investing powerhouse in human history, they're sitting on a mountain of cash, and I mean a jaw-dropping, unprecedented mountain. Why is the absolute master of long-term investing walking away from the table just as the party gets going?
Okay, let's dive right into this. You look around, and despite all the anxieties out there, crazy interest rates, complex geopolitical tensions keeping global markets totally on edge, everyday retail investors are just blindly pouring their cash into equities. It's a serious case of FOMO. But the heavyweights at Berkshire? They are doing the exact opposite. They're quietly retreating to the sidelines, and it forces us to ask a really uncomfortable question. What on earth do they see in the data that the rest of us are completely missing?
To really wrap our heads around this, we got to look at the raw numbers. By the end of the first quarter, Berkshire's cash and short-term T-bills exploded to $397 billion. Let that sink in for a second. That is an absolute all-time record for them. To put that into perspective, that pile of cash is literally larger than the entire GDP of several developed countries. It represents well over a third of their total market value. Even for a famously conservative company, their cash has never made up such a massive slice of the pie.
So let's play detective for a minute and break down the anatomy of this record-breaking treasure chest.
Now, this money isn't just sitting in some giant steel vault gathering dust and losing value to inflation. Not at all. The vast bulk of it, about $339 billion, is safely locked into short-term U.S. Treasury bills. The remaining $58 billion or so is held in cash and equivalents. So when you combine those, Berkshire has nearly $400 billion parked in literally the safest, most liquid assets on the planet. They're taking absolutely zero risks right now, prioritizing total safety and immediate liquidity over everything else.
And just look at their exact moves during the first quarter. They sold $24 billion worth of stocks and only bought $16 billion. But here's the crazy part. This isn't some sudden knee-jerk reaction to a single bad quarter. No, this cements a highly deliberate, methodical net selling streak that has dragged on for more than 3 full years. While the rest of the market has been climbing higher and higher, they've been quietly and ruthlessly offloading their positions to raise capital.
Now, human psychology might trick you into thinking, hey, isn't holding that much cash a losing game against inflation? Well, with short-term T-bill yields floating around 3.7%, this war chest is throwing off roughly $12 billion a year. Let me repeat that, $12 billion in purely risk-free interest. That completely eclipses the total annual operating profit of many big S&P 500 companies. When the greatest value investors in history decide a 3.7% risk-free yield is better than buying businesses, man, that's a flashing neon sign about how expensive the broader market is right now.
And this brings us right to Warren Buffett's core philosophy on capital. He doesn't see cash as just some defensive, passive hiding spot from volatility. For him, cash is optionality. It is essentially a loaded weapon of opportunity. It gives you the exclusive ability to move swiftly and decisively when high-quality assets finally get cheap. Because Berkshire is so massive today, they have to drop tens of billions of dollars just to move their own financial needle. So they have the luxury of sitting back, being patient, and waiting for that perfect golden opportunity rather than settling for mediocre returns.
So, is history about to repeat itself? Let's take a look back to see if this huge cash pile means a crash is coming.
If we look at the timeline, Berkshire's psychological playbook is incredibly consistent over the decades. Back in the late 90s, during the whole dot-com boom when everyone was getting rich on wild speculation, Buffett just sat quietly on the sidelines. He took relentless criticism for being out of touch right up until the bubble burst and completely vindicated his patience. We saw the exact same cycle play out right before the 2008 financial crisis. They endure the criticism, hoard cash when bargains disappear, and then they mercilessly spend it when widespread panic creates once-in-a-lifetime deals.
Just think about how they actually used that cash in 2008. It's an absolute masterclass. When Wall Street was in total, paralyzing terror, Berkshire went on the offensive. In September 2008, they pumped $5 billion of emergency capital into Goldman Sachs and got an unbelievable, guaranteed 10% dividend in return. I mean, those are mythical, ultra-favorable terms a regular investor could never even dream of. But that's the real, unparalleled power of holding massive liquidity during a crisis.
Now, I do want to add a quick self-correction, or at least some deep nuance here. Buffett himself constantly warns us not to treat this cash pile like a definitive crystal ball predicting a market crash tomorrow. Historically, Berkshire has held on to enormous amounts of cash through long stretches where stocks just kept going up. So it's not a doom and gloom prophecy that the sky is falling.
It's just a foundational strategy of extreme preparedness. They simply refuse to overpay for assets.
There is, however, one fundamental change at the very top of the company, making this entirely unprecedented.
Yep, at the end of 2025, a historic shift took place. Warren Buffett officially handed the CEO reins over to Greg Abel, choosing to stay on as chairman. What this means is that Greg Abel is now the primary guy holding the keys to this $397 billion war chest. How this new leader deploys this capital, and exactly when he decides to strike, is arguably the single biggest factor that's going to dictate Berkshire's returns for the entire next decade.
And so far, Abel is sticking rigorously to the script, the exact same disciplined, cautious script Buffett spent decades building. Sure, he's made a few strategic moves, buying some Alphabet stock, acquiring Taylor Morrison Home to boost their domestic side, but ultimately, at the close of the first quarter under his leadership, the company was still a heavy net seller of equities. The core DNA of patience and protecting capital hasn't budged a single inch.
So what does this all mean for you? Let's bring this masterclass directly back to your own portfolio.
Here is what you really need to internalize from all this. First, doing nothing, just extreme patience, is actually a highly active strategy, especially when markets are expensive and your neighbors are seemingly getting rich. Second, holding a strategic cash reserve isn't about perfectly timing a market top. It's about having actual financial ammunition ready to change your life when panic hits and prices finally plunge. Ultimately, true wealth creation comes down to emotional intelligence. Can you sit on your hands and do nothing when it counts?
While the smartest investment minds of our time comfortably sit on hundreds of billions in risk-free yield, they're silently reminding us that the biggest, most life-changing payouts go to those who can master their own impatience. You build up your reserves, you study the fundamentals, and you wait. The real question is, do you have the unshakable discipline required to wait for your own perfect pitch? Thanks so much for joining me for this explainer, and I'll catch you next time as we continue to unpack the financial world together.